The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The buy the dippers step in and the market takes off. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. I missed a big market move last week.
So I heard too. I was also gone as well. Welcome back.
All right, let's get a check on where markets stand right now because we're looking at stocks recovering from last week's sell-off. The S&P 500 holding near session highs, up about 1.25%. Its first gain in 5 days. The 2-year yield, little change right now and today after falling as much as 29 basis points on Friday following that weaker than expected jobs report. Crude oil, NYMEX crude now down to $66 a barrel as investors digest OPEC Plus's latest plans to increase production in September and keeping an eye on the Swissy that's weakening as the Swiss government makes really clear, Romaine, that it's ready to make a more attractive offer to the U.S. after Trump threatened 39% tariffs on the country.
Yeah, Scarlett, both of us were off on Friday, so we missed those downward market moves. So kind of interesting to see the move higher today. And I don't want to look a gift horse in the mouth, but there is still a touch of defensiveness to today's rally. On a pure factor and a long short basis, it's momentum stocks out front to be sure. But dividend payers, they're not far behind. Furthermore, you have investments in U.S. listed bond ETFs increasing for 16 straight weeks, and that adds to a year-to-date growth rate that has been roughly double the inflow growth that we've seen into riskier equity ETFs.
When you've had such a fast rebound and where valuations are, you do have to be cautious. And this is where you start to take some money off the table in terms of your stocks. I mean, I'm still fully invested. I'm going to remain fully invested. But you do have to have some risk management. That means taking profits in some names.
Not a whole lot of that going on today, and if you want to parse today's market action, one thing is clear. Whatever pressure the S&P faced on Friday from the labor market blowup, from the Fed governor vacancy, from the Trump tariff deadline, that pressure did become a buying opportunity in a big way across asset classes, crypto, precious metals, long-dated bonds, and of course, long-duration stocks. Big moves today in big tech, including NVIDIA, Apple, Meta, and Palantir. Keep an eye on Palantir. That's the best performing stock in the S&P this year, and by traditional valuations, the most expensive. Whether that high multiple is justified, that's going to be put to the test after the bell with its earnings. And in the 19 quarters of earnings since the company went public back in late 2020, Palantir has beaten EPS expectations in 14 of those quarters, and Scarlett beaten revenue consensus in all 19.
That company seems to know how to manage earnings expectations, right? All right, well, you mentioned how momentum stocks are out front today. Let's talk about momentum for equities overall. John Authers featured this chart in his column today, and the white line shows the performance of SPY versus TLT, which are proxies for the stock market and the U.S. Treasury market. So the blue line is the 50-day moving average, the short-term trend line. When the white line goes down, as it did on Friday dramatically, that reflects stocks underperforming bonds, marking a huge shift from the relentless outperformance of stocks since April. Now, you can see how for the second summer in a row, go back to last August, we have started the month with a dramatic reversal for stocks. So you wonder where that takes us, Romaine.
Yeah, big question here on a big day as we kick off the week with Stephen Laipply, global head of iShares fixed income ETFs over at BlackRock. And Stephen, this gets to the question here. Anytime we have these big sell-offs, and sell-offs we should point out that are usually sort of spurred by some sort of fundamental change, this time Washington policy. Do we learn anything from that? I mean, because looking at today, if you were away from the office on Friday, you would have no idea of what exactly transpired.
Yeah, I think it's interesting, Romaine. And for us, it just kind of reinforces the idea that you have to have a resilient bond portfolio against your risk assets. So, you know, there will be days like Friday where you will have risk-off environments. And I think, you know, a lot of times investors are tempted to try to, you know, sort of time the peak in rates as an example. I think Friday shows you that having a broad, diversified bond portfolio can be really beneficial. One thing, you know, that's interesting to me in particular, I think investors have been a little bit worried about the long end of the yield curve as of late. What's really interesting is, you know, 20-plus treasuries, TLT, returned around, 1.4%. That's almost half of the return year to date, just on one day. So that shows you how quickly things can change. So what we're advocating for, have a broad, diversified bond portfolio. Don't put all your money in one particular part of the curve. Lean into income, lean into quality.
Yeah. I am curious, though, about risk in the fixed income space. I know by tradition this is a relatively safe asset class, even when you're talking about corporate bonds. But there's this idea right now that so much of what's driving the market is policies out of Washington, rhetoric out of Washington, things that could potentially have a fundamental effect on the economy and in turn, maybe on the bottom lines of a lot of the companies that have to repay their debt. And for that matter, Stephen, the government itself.
Yeah, and there's a lot of debate about where deficits are going, what will be the implications of some of the legislation that's been passed recently. How will tariffs play out in that equation as well? We did see term premium on the longer end of the yield curve rise pretty significantly. So far, investors seem to be holding relatively range bound in terms of where they've repriced yields. Yeah, we had a pretty big drop on Friday, so we're in sort of the 420s right now or below. But in term premiums come in a little bit. So I think there's a little bit of a wait and see going on as far as longer dated bonds go.
Stephen, how much do you look at what we're seeing in the equity market, in particular the outperformance of stocks over the past couple of months, certainly to any other asset class, in determining the short-term view for bonds?
And again, I think, yes, there will be a trade-off. You will see people mostly, I think, leaving cash or cash proxies to go into equities when equities become attractive. What we're seeing, though, is very, very consistent bond flows. So we set a record in the first half of the year despite performance in other asset classes. We set an all-time record. I think, in the U.S. alone, we took in about $180 billion as an industry in fixed income ETFs. iShares was over a third of that. And we continue to see very, very strong flows. It's mostly higher quality, so think treasuries, broad, multi-sector funds, and some high yield, actually, as well as defined maturity products. But the point is investors continue to invest in income in bonds.
And you mentioned that you want to have a resilient bond portfolio. You want to lean into quality. You want to lean into income. What does that look like once the Federal Reserve does begin cutting interest rates as expected in September?
Well, Scarlett, it's really interesting. So we've taken in around $30 billion in Treasury flows this year. 20 odd of that, I think it's around 23 billion, has gone into 0 to 3 month Treasury bills. SGOV is the fund that has had those flows. Now, it's going to be interesting to see if that holds or if that money starts moving out once rates are cut. Investors may choose to move out a little bit more in the curve. They may choose to lean into more income yielding sectors like high yield or floating rate product. It'll be interesting to see once that first cut comes. And now you're really almost fully priced for September. So we think the cut's probably almost a lock for September.
When we get beyond those September, Stephen, there's been a parlor game here. Not so much just about, okay, does the Fed cut again in 2025, but the idea of how many cuts maybe we get extending into 2026. And as you try to allocate into the fixed income space, how much do you count on those multiple cuts?
Yeah, and you're right. It is quite a game. So we went from being at about roughly 2 cuts, maybe a little bit less priced in before Friday. We're now approaching, 2.5. Now, obviously, there's not really a half of a cut, but it shows you how much the market's moved and the probabilities have adjusted. I think we're seeing, into next year, well over, 4 to 5 cuts, over a percentage point. We'll see if investors continue to reprice that. Everybody's debating the jobs numbers from this past Friday. People are going to be watching closely. So far, inflation has been relatively well behaved. There's a lot of speculation that tariff effects haven't quite fully moved through the system yet, so people are going to be watching that. But so far, the market's cooperating with a positive tone in fixed income.
All right, Stephen. Great stuff. Stephen Laipply there, co-head of iShares fixed income ETFs over at BlackRock, kicking us off to the close here on this Monday afternoon with the eye on tariffs and an eye on the trade deals and an eye on a big bargaining chip in those trade negotiations. And that's America's natural gas. A discussion up ahead with Toby, CEO of EQT, the largest producer of natural gas in the U.S.
Plus, we're talking trade. So what is next for India? What's next for Switzerland? And President Trump's influence on the markets with Michael Zezas of Morgan Stanley.
And a conversation about artificial intelligence, given those earnings out of Palantir, and more importantly, the regulations around them. Alondra Nelson's going to be joining us in just a second, member of the UN Advisory Body on AI. All that and more coming up in just a bit. This is The Close on Bloomberg.
All right, checking on natural gas prices today, sliding as much as 6.1% despite rising temperatures across the United States. Even with forecasts for continued heat in coming weeks, supply remains the key driver, which is pressuring prices. Prices have actually been on a downward trend since March. So what do industry leaders see further out? Let's ask the head of the largest producer of natural gas in the U.S. He is Toby Rice, CEO of EQT. Toby, it's good to speak with you. I want to start there and get your outlook for the nat gas market as we move toward the start of autumn here in the United States, where demand for air conditioning subsides and the winter heating season is still a few months away. What do you see?
Well, we see weakness in short-term natural gas prices showing up in storage levels that are about 6% higher than normal. But looking out past the next, call it 6 to 12 months, it's hard not to get really excited about natural gas. The fundamentals really improving, and this is really driven by two major themes that are hitting natural gas demand, both the power demand that's coming in this country and at the LNG build out. We see between 20 and 40% more natural gas needed to meet that demand. And that means the current supply levels we have now are not going to cut it. We need to see price signals that would allow operators to grow their activity levels.
How does the shifting tariff landscape also factor into your outlook? What kind of assumptions are you making there?
So on tariffs, for us, as it relates to our business directly through costs, we don't see a material impact on our business. But I think the bigger picture for tariffs is how our government is using energy as one of the tools to balance some trade deficits. So all of this means for natural gas, LNG being the largest exporter of LNG in the world, that is the United States position. You know, these tariffs and energy as a tool to balance trade is going to mean a stronger pull for more domestic U.S. LNG, which is going to send an even more stronger demand signal to domestic U.S. gas markets. So again, we think it adds to the bullishness of natural gas long term.
I'm curious with some of the trade deals and really just overall, even absent of the trade deals, just a lot of the export opportunities that have cropped up for LNG and really just the broader energy space. How do we get to the point, Toby, where we can kind of improve our infrastructure so we can get more of this stuff out there? I know you got a lot of stuff already ready to go in terms of infrastructure down there, down south, but there's still a lot of questions about what more we can do in Alaska and what more we can do in other parts of the country where we don't necessarily have those export capabilities.
Well, number one, you need the market to signal that this infrastructure is needed, and the market is screaming for more energy infrastructure. You want examples of looking to that? Go look at gas prices in Boston this upcoming winter. They're scheduled to be higher here in Boston than they are over in Europe. I mean, that is the market screaming for more energy domestically, and around the world, the appetite is even larger. So the market signals are there. The motivations to get this infrastructure built, I think, have never been stronger. I think the world understood how important energy security is when the bombs dropped in Ukraine. You look at this, the energy that's needed to meet this next big major catalyst, this AI power demand. It's an incredible motivator to make sure that we win this race and get this power built. And so the motivators are there, the market signals are there. We just need to get back to a place where we can get stuff built in this country. And unfortunately, it's going to require some legislative reform to get perm reform so we can get back to a country where we get things built. I am very optimistic that we get there. It seems like this administration has moved through a lot of big priorities, and now it leads us back to a place where we've got to get back to the basics, get back to building. And the opportunities that await for companies like EQT and Americans and global citizens are tremendous.
With regards to data centers and all of these kind of new projects, energy-intensive projects in the tech and AI space, Toby, how do you sort of forecast out as you're sort of trying to plan your business longer term? Because we've seen a huge groundswell, obviously, in demand. Presumably that's a spike, and at some point that'll level out. How do you sort of forecast and sort of predict where you want to be, where that puck is going to be 5 or 10 years down the road, as opposed to just this upswell in demand today?
Well, I think you can take a step back and look and see what's happening in the world. And one big theme that certainly is emerging that I don't think anybody is disagreeing with is the fact this world is electrifying. And an electrified world is going to need more electricity, and that's going to be coming from natural gas. So we're pretty confident. You know, when you see the hype around AI, it's easier to look at this and say maybe some of these estimates are overstated for the power demand domestically, but take a step back and look at that power demand growth. Only about 40% of that is attributable to the build out related to AI. So there are other major themes that are taking place that are causing more electricity. So when we look at this, we think the range is anywhere between 10 to 18 BCF a day of more natural gas is needed to meet this build out. That is a pretty tremendous number, but for perspective, this industry has been able to deliver that on those volumes. You look back 10, 15 years, and you've seen natural gas power gen has increased over 14 BCF a day. So what we're looking at in front of us is exciting. It's large, but this industry has the scale and the track record to be able to deliver.
All right, Toby, got to leave it there. Appreciate you taking time for us. Toby Rice there, he's the CEO over at EQT, largest natural gas producer here in the U.S. and, of course, one of the better performing stocks amongst the broader market, but none of them really come close to what we've seen with Palantir. Those shares have more than doubled since the start of the year, and they're expected to report earnings after the bell tonight. We're going to preview what investors and analysts alike are looking for. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with Kimberly-Clark. JP Morgan upgrading the maker of Kleenex and Cottonelle to neutral. The price target up to 138 from 125. The analyst says the company's recent product launches across value tiers should bring benefits later in the year. That stock up for a second day to its highest since June 12th. Up next, Coinbase. Compass Point cutting the crypto trading platform to sell, lowering the price target to 248. The firm now seeing, quote, limited support for the valuation if crypto markets sell off further. Those shares, which sold off by 17% on Friday after its earnings, up 1% here on the day. And finally, let's take a look at Viasat. William Blair raising its recommendation on the broadband digital satellite communications provider to outperform. This ahead of the company's earnings tomorrow. The analyst has no price target, but does say he expects greater than 100% upside to the shares over the next year. Those shares already up today, 22% to 2016, and those are some of our top calls. We do want to keep an eye on another big performing stock, and that is Palantir. The share is up 4% on the day, have more than doubled since the start of the year. The data analytics company set to report 2Q results after the bell. High expectations for a stock is highly valued. Gil Luria joins us right now, Managing Director and Head of Technology Research at D.A. Davidson. He's got a neutral on the stock. All right, Gil, I mean, no one doubts the growth story for this stock. I guess what some people might doubt is a forward PE ratio more than 200, a price to sales ratio at 70, 80 times sales. When you look at the valuation, does it give you pause at all, Gil?
Yeah, significant pause. This is unprecedented valuation for a company of this size. We haven't really seen that for several years. In 2021, there was a period where some high-growth software companies were trading at these types of valuation, but nothing ever since. And right now, Palantir trades at a significant premium to any other software company, including Figma that just went public. That's probably the closest second, maybe at 40 or 50 times revenue with similar growth rates, maybe even slightly faster growth rates, which is to say the growth at Palantir is remarkable. It's the fastest of any other software company except for Figma at this scale. Their profitability is tremendous. They have more than 40% operating margins, which is better than any other company that's growing anywhere near this. So they're deserving of a premium valuation, but what a lot of institutional investors struggle with is how much of a premium are you willing to pay and how sustainable that premium is if they have any type of hiccup anytime soon.
Is there any reason why investors should maybe give this stock a little bit more of a pass, partly because of the relationship that the founders and some of the lead investors have with the current administration, the idea that at least in certain realms of government contracting, it seems to kind of have the market all to itself? I mean, there is certainly a moat here for this business.
That's exactly right. And that's why investors like this story so much. And in fact, individual investors have led the way on this in understanding that Palantir has a huge opportunity ahead of it. On the government side, you mentioned a couple of the big advantages. One is that the government, by and large, and especially the Department of Defense and related agencies, are trying to move to dual source software, which is what they call it when it's a commercial vendor developing the software off the shelf for them. And let's not forget, most of the success has actually been on the commercial side where they've been able to really have a tremendous product market fit for what they do. This is the company that is helping now numerous enterprises create an AI strategy, solve the two big problems, which is how do you at once able to bring tools off the shelf and a framework off the shelf while at the same time bringing in the professional services to make it happen for these enterprise customers. Many of their customers were struggling to figure out how to make their data work for them to make AI applications, and Palantir is solving that problem for many companies, which is really a standout performance right now.
Gil, which is more valuable to investors, growing that commercial business or growing that government business?
The potential for the commercial business is greater. That is a much greater market that's growing a lot faster. And so I think that a lot of the excitement is, can that business become even bigger than the government business? But the government business, as you were pointing out earlier, they are very entrenched. They have a big lead. There's very few companies that can do anything remotely like what they can do, where on the commercial side, it is far more competitive. There's a lot of other companies trying to help commercial customers with their AI strategy.
You know, I look at the free cash flow, and it's expected to be about 35% of revenue, about $330 million. What is the company going to do with all that cash? What do investors want to see it do with it?
Well, they're using some of it, even at these rates, they're using some of it to buy back stock. There's not a lot that they need to acquire. Again, they have the product they need to address the market. So they're just building a fortress balance sheet. They're actually getting great returns on it. That helps with the profitability. And so I wouldn't necessarily expect for them to need to go do a big acquisition. It means they can handle any project, large or small, within government. So it increases the ceiling of the type of projects that they can be the lead contractor on. So it's very much playing to their strength. And again, they're even using some of it to buy back stock, even at these valuations.
Yeah, it's a high-class problem then. Gil, really appreciate it. And of course, Palantir will be reporting results after the closing bell. We will be all over it then. Gil is Managing Director and Head of Technology Research at D.A. Davidson and Company. Coming up, we've got a conversation with Michael Zezas. He is Head of U.S. Public Policy Research at Morgan Stanley about the latest in U.S. trade policy, what it means for the global economic outlook, and what it means when you're a company that gets name-checked by the president and it moves your share price.
Oh, big time.
This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. And of course, we're always keeping an eye on these meme stocks and how much they've been getting a lot of attention. But
you mean like on semiconductors, down 15%?
I wasn't thinking of that one.
Open Door?
No, not that one either.
Okay.
Although they were in the
Which
spotlight a while ago.
Yeah.
I was thinking more of American Eagle Outfitters. You know, it was definitely in the meme stock atmosphere
Yeah,
before.
they've been in the news lately.
They have been.
Yeah.
Well, they had this incredible ad that kind of went viral.
Yeah, I mean, I remember they were like a thing years ago, right? And then they kind of fell out of favor.
Yep.
And then apparently, I didn't know this, but apparently the president put out a Truth Social about them, saying that basically they're hot again, right?
Yes,
They're flying, all their jeans are flying off the shelves, and apparently this all has to do with Sydney Sweeney, registered Republican, by the way.
Oh, according to President Trump, although he did spell her name S-I-D versus S-Y-D initially.
I mean, we make fun of it, but in all seriousness, I mean, I'm actually fascinated by this because we talk about just how much this market, since Trump got elected in November of last year, and when he got inaugurated this year, of how much he moves the market through a simple tweet or Truth Social or just some other proclamation about some company he either likes or doesn't like, some actress he likes or a singer that he doesn't like, and the market just seizes on it and just goes bananas with
It's an offhand remark for him, but it's like millions and billions of dollars in market cap for them.
It's serious money.
So serious money with serious implications. Let's extend this conversation a little further here and bring in Michael Zezas. He is Head of U.S. Public Policy Research at Morgan Stanley. And Michael, to that point, to what Romain was saying, the president has this incredible ability to move markets, whether it's entire asset classes or individual securities prices, which means that getting name checked in his social media posts or in his comments when he does make them live is a real thing. Do companies tend to see this as a genuine risk or as a genuine opportunity?
I mean, it's a great question. I can't say it comes up a heck of a lot in our discussion with companies. I think for the most part, they're just trying to optimize their strategy for what the economic reality is that's obviously being shaped by the politics and policy, and probably want to be more known for if they have an optimal strategy and if they're going to continue to make money from here on out. I've not seen any indication that there's a focus on name checking per se.
Right, fair enough, fair enough. Yeah. Of course, for a company like Paramount, which settled with the president a $16 million settlement over a lawsuit alleging election interference, can they rely on the idea that because they made nice with the president over concerns about their editorial decisions, that they kind of have a clear runway from here on out when it comes to operations?
Yeah, I mean, it's an interesting question. I mean, it's ultimately one of the personalities and regulation. I mean, listen, when we've talked about regulation, we've noted that actions by the executive branch sort of relying on those things to make changes, either positive or negative, that are going to impact the macro outlook, that's really kind of hard to piece together. And so, again, I think sort of gaming for specific regulatory outcomes, particularly when you're trying to operate a business around the macroeconomic environment, is probably not the area to focus on. I think looking more at legislative outcomes. And then I think one thing that's obviously within the executive branch's control, tariff outcomes and how that's going to impact costs. That's been a much bigger theme for corporate decision making with the clients that we're talking to.
Well, now that August 1st is come and gone, Michael, and I know there are still a couple other deadlines floating around out there. It's kind of hard to keep track of it all, but we do kind of have a better understanding of at least what maybe sort of the baseline, what that floor does look like when it comes to tariffs. As you start to model then going forward what the effect is going to be, do you have a clearer sense?
Well, I think what we've done here is we've sort of taken what was a very wide range of uncertainty after April 2nd, which was that the effective tariff rate of the U.S. could be as low as 10%, maybe as high as 30%. And we're now in a range that's probably going to be more like 15 to 20%. Which, by the way, is where we thought we'd be when we started modeling out scenarios at the end of last year. We've maybe arrived at that point a little bit faster. We thought you'd get to like a 15 to 17% range by the end of the year. But just sort of having less uncertainty there means that we also feel like the economic consequences of that are a little more clear. So our economists have been using these forecasts and feeding it into GDP and inflation. And the story all along for us has been slower growth, higher recession probability. You're starting to see that play out in the economic data, probably more to come over the course of the year. And that's something that we think is ultimately going to be pretty constructive for fixed income assets overall as yields start to move lower.
But do you think that certainty and clarity is going to be consistent, Michael? I mean, today we came in and there's headlines about India and the potential for tariffs being higher there because of Trump's dissatisfaction on Russian oil. Obviously, a lot of concerns about what's going on with the Swiss, who clearly don't have the capacity to buy the amount of goods that we seem to be forcing on them. And then we were remiss in not pointing out that all of these so-called deals aren't really deals. I mean, they're handshake agreements, they're frameworks, if you will, but you still have to put pen to paper and actually get something signed in order to have some sort of enforcement mechanism for those goods and services to be bought.
Yeah, I think that's totally fair. We reduce the range of uncertainty, but there's still plenty of uncertainty. And then there's kind of a time aspect to this too, right? So a lot of these arrangements have tripwires, for lack of a better term, in the sense that there's some committed asset purchase that's supposed to happen in the future. And depending on the countries we're talking about, there's questions about whether or not those asset purchases could be made. Can the U.S. even supply some of that stuff that they want these other countries to buy, or at least in that size? That seems like it creates future uncertainty. But in the short term, these arrangements may be kind of heavier in range. And then I think right now the uncertainty pivots to, okay, well, if we have the effective U.S. tariff rate about 4 times higher than where we started the year, we know there's a cost to that. It should be borne out in economic data. It should be borne out in corporate earnings. But to what degree and what severity? So I think the next few months, the uncertainty is really around how that plays out in economic data and in earnings.
Right, and especially as companies are eating a lot of those costs. We've seen that custom duties, along with some excise taxes, have generated about $152 billion through July. That's more than double, or about double, what the U.S. government collected the same time last year. How's that currently showing up in the numbers in the economy, and how do you expect that to eventually show up?
Yeah, well, so the way our economists think about it is that the lag between some of these tariff actions and impacts in terms of real economic activity, corporate decision-making, employment, historically that lag is several months, 3, 4, 5 months. So that means we're really just starting to see this play out in the economic data, and perhaps you got a hint of that in the labor number from last week. So I think over the next 2 to 3 months, we have to look really carefully at labor data, at inflation data, and the product by product breakdown to see, is the economy effectively absorbing this? And we should be growing at 2+%, the kind of run rate that you would have expected had these tariffs not been implemented, or is going to be something more like our economists expect, which is around 1%, maybe with some downside, higher recession risk. And again, that's the type of thing that we think is going to feed through into lower bond yields.
Any concerns, though, Michael, going forward about the integrity of that data, given some of the developments over the last few days?
I mean, it's an excellent question, and I think we should always be scrutinizing data, and we should really need to have good, strong, reliable data. I'm not an expert in the process, but those who are have told me that, in the near term at least, the process that you're talking about that aggregates this data and pushes it through, that's pretty robust. So we should really kind of continuously focus on this and scrutinize it, but I don't think there's any reason in the near term to make substantially different conclusions than you otherwise would have.
All right, Michael. Always love you having you on the show. Michael Zezas there, head of U.S. Public Policy Research over at Morgan Stanley, as we continue to count you down to these closing bells. When we come back, we're going to take a closer look at some of the big movers on the day, and that includes Spotify. The share is hitting a sweet spot after announcing subscription price hikes.
No more.
Ruining the day for Scarlet Fu. It's our stock of the hour, or at least it is for me, not for Scarlet.
No
it's coming up next here on The Close. This is Bloomberg. Time now for our stock of the hour, Spotify. That's the name. The shares up 5.2%. This after the audio streaming service announced it's raising its premium subscription prices across several markets outside of the U.S. Geetha Ranganathan joins us right now, U.S. media analyst over at Bloomberg Intelligence. So I guess not a surprise. I feel like all these streamers, as soon as they find an opportunity, they nudge that price up to some degree or another. But is there any sort of concern on your part, Geetha, that this could maybe lead to some degree of attrition?
Not at all, Romaine. I mean, one thing that we've seen with Spotify and a lot of these other services, you think about Netflix in the video streaming world, is that because they've kind of pretty much dominated the space, we see very, very low churn after they announce price increases. So the one thing that I would want to note for Spotify is, at least in the US market, since 2011, they have actually hiked their price only twice. They did it once in 2023, they did it once in 2024. Investors were kind of expecting them to raise prices in the US this year as well. They haven't. And that's actually why we had a little bit, last week they reported earnings. It was a little bit underwhelming because we were really kind of expecting that price increase. But now they announced this price increase across many other markets outside the US.
That's interesting you bring that up. What is preventing them from doing that? I mean, is there a ceiling at which U.S. consumers just will not put up with more price increases, especially given that they had back-to-back price increases in 2023 and 2024?
So they didn't raise prices, Scarlett, for more than 10 years. So right now, I mean, they've raised prices over a period of almost 14 years. They've raised prices only by 20%. You compare that to Netflix. Netflix has raised prices by 125%. So 7 price increases over the same time period. So I think what they're really trying to do, Scarlett, is they don't want to raise prices too quickly. They spoke a little bit about this during their call as well. They want to first add more features. And that's exactly what they're doing. They're kind of really building out their product with audiobooks, with new video podcasts, they already have a best-in-class user interface, but they're adding more AI-powered, curation tools, personalization tools, recommendation engines, an AI DJ mixer, all kinds of things, which kind of then, I think, emboldens them to take that pricing increase. So they're definitely going to do it, but they're going to do it in a very much more, measured, disciplined way across all their markets.
When it comes to the growth, or whatever sort of their long-term growth ambitions are, Geetha, I mean, what does this company become? I mean, is it just going to basically be the place where I go and listen to music, or I guess the podcast as well, or does it have ambitions to be something more than that?
Oh, absolutely. I mean, they are going to lead. I mean, they already pretty much lead when it comes to music, Romaine. So if you're just kind of looking at the global digital audio market, Spotify has a 33% share. in terms of listenership. You compare that to any of the other big tech players. You look at an Apple, an Amazon, a YouTube. Those are all close to about 10% each. So Spotify already kind of dominates. But over time, really their aspiration is to kind of become not just a music platform, but really this global audio powerhouse. Yeah. So think about, of course, audio books. Think about podcast content. All kinds of different things that they can introduce on there, and that's exactly what they're doing, and they're building that part of their business.
All right, Geetha Ranganathan, fantastic context there. U.S. media analyst with Bloomberg Intelligence. I don't know about you, but I have Spotify, and those price increases Geetha mentioned in 2023, 2024, threw me for a loop, and I was ready to cancel.
Yeah, I mean, my son has it, so it's our family plan. But I don't listen to it. I still kind of prefer just listen to my own stuff. Like this morning,
What, you download and own your own music?
I do. I am that
old.
I actually have albums still, Scarlett. I was listening, walking into work, vinyl albums. I was walking into work, and I was listening to Paid in Full, Eric B. and Rakim, which is hard to do carrying that turntable down the street.
Yeah, I know. I can imagine.
I made it work.
Yeah, everyone's looking at you. All right, coming up, we're going to take you to the closing bell with Mona Mahajan over at Edward Jones. This is The Close on Bloomberg.
So far, inflation has been relatively well behaved. There's a lot of speculation that, tariff effects haven't quite fully moved through the system yet, so people are going to be watching that. But so far, the market's cooperating with a positive tone in fixed income.
Stephen Laipply, global head of iShares fixed income ETFs over at BlackRock, kicking us off just about 50 minutes ago here. A sizable rally on our hands, trying to recoup some of the sizable losses from last week.
And we're really seeing strength in mega cap tech stocks. You can see the Mag 7 up about 1.9%. Ditto for the small caps as well, as this idea that the Fed will definitely be pushed to cut rates in September really takes hold. I mean, people are already pricing it in, but now it feels like it's a done deal.
Yeah, but done deal why? Right? If the economy is weak, I mean, why would that benefit small caps?
Well, small caps have been counting on some kind of rate cut for a while now, so perhaps this is just, the final step towards unleashing a series of rate cuts. We should point out as well that energy stocks are the one weak link in the market today as oil prices fall. NYMEX screwed down about 1.8%. Yeah, 10 of the 11 sectors in the green here on this day, with the S&P up more than 1%. And as you saw there on your screen, the outperformer, believe it or not, is the Russell, up about 1.9%, keeping pace with the big cap Mag 7. Mona Mahajan joins us right now, head of investment strategy at Edward Jones. And there is now a big bet in this market, Mona, on rate hikes. And I know we've kind of gone back, rate cuts, sorry. I know we've gone back and forth with this all year long with the market pricing and all these rate cuts and then peeling that back. Based on the economic data that we just got, are you now in the camp that the two rate cuts that were penciled in on that dot plot are a sure thing?
Yeah, thanks, Romaine. And look, we had a shift in narrative on Friday on two fronts. One, of course, the job market looks a lot softer than we had originally anticipated. The revisions were pretty dramatic, and we are seeing that slowing that we had all seen a little bit anecdotally. The second big shift, of course, is the shift in the Fed policy narrative. And, the markets have swung. Pendulum has probably swung a little bit too far too fast, looking at 2 to 3 rate cuts. We remain in the camp that 1 to 2 cuts are likely this year, and an additional 1 to 2 cuts are likely next year as well. Now, that narrative initially, for us at least, was based on inflation remaining contained and becoming even more contained over time. Now, if the Fed is cutting rates, in fact, because we are looking at a softer economy than expected, historically, markets haven't performed as well in that environment. And so, look, we've gone through a 20% plus rally in the S&P 500. We're heading towards potentially a softer economic environment. August, September, historically not great for markets. It seems ripe for a bit of volatility, but we are hopeful that the 2026 narrative can improve.
I am curious, though, Mona, about the idea of rate cuts and what it would actually mean for asset prices, particularly given that stocks are already, at least in aggregate, at all-time highs or near all those all-time highs. I mean, what does 25, 50 basis points really do, other than maybe just the optics, I guess, that the Fed is there to rescue them?
Yeah, look, markets always welcome Fed rate cuts. And we know lower interest rates are typically preferred across the board by investors, whether it's in asset classes like equities or asset classes like real estate. And so lower rates are generally what drive market performance in the near term. Now, to your point, though, when you do cut rates, it does take time to actually work through the system in any meaningful or real way, usually 3 to 6 months on average. And so if we are entering a period of economic softening, the Fed does cut rates, we're still not looking towards, or at least until early 2026, until we see that flow through in terms of whether that's mortgage and housing economy, or even things like consumers and corporations taking out big loans. And so we do think that the Fed cutting rates will eventually flow into the real economy. We know markets are forward-looking, so it makes sense for them to start pricing that in ahead of time.
You know, Romain and I were talking earlier about how the president has this ability to move markets, entire asset classes or individual companies, just based on his mentioning something, verbally or in a Truth Social post. And I guess my next question to you is, he has promised to name a new candidate for Fed governor to replace Adriana Kugler. Do you see this as something that could change pricing on what the Fed does next if he does appoint someone who's a noted dove?
You know, look, I think the good news is the Federal Reserve Board, the FOMC, is made up of 12 participants. They are all voting members, and that vote, any one person will have trouble swaying, even if it's the Fed chair. All that being said, we are heading into an environment where if the economy is softer, regardless of who is put into place by the administration or not, we may be looking at a Fed that is poised to move rates lower, and perhaps move rates lower not only because the economy is softening, but because this inflation narrative thus far hasn't really been as sticky as we thought. So yes, to your point, one person can make a difference, but probably not all the difference.
And also, the jobs report on Friday really made clear that the higher tariffs is certainly weighing on consumers, is showing up in the data, albeit in small ways for now, and expected to increase as the year goes on. How do you expect that to show up in the remaining earnings that we're going to get, particularly when it comes to the consumer companies that will be coming out in the next couple of weeks?
Yeah, it's something we're watching carefully because, of course, thus far, inflation, CPI headline inflation at 2.7%, relatively contained. Yes, it's above the 2% target, but certainly not at levels 8-9% that we had seen in the post-pandemic environment. Part of that, of course, is companies had built inventories. We know that from the GDP data. And some of those inventories will have to be replenished now at perhaps higher tariff rates. We also know partners across the supply chain have been taking margin hits. And part of that, a lot of those partners who had absorbed the cost of tariffs may not be as willing to do so in the months ahead. So we would expect certain goods pricing to start moving higher. But keep in mind, as we've talked about, goods is only about a third of the overall inflation basket and about a third of the overall experience that households have in paying for goods and services. The majority is still a services-driven economy, 2/3 services. So if that continues to remain in line or even move lower, the tariff impact may be a little bit more modest than we expect.
All right, Mona. Great stuff. Mona Mahajan, head of investment strategy over at Edward Jones, counting us down to those closing bells. We're just about 3 minutes away from that with pretty sizable gains across the tapes here, with the Russell now hitting back at session highs, up 2%. The NASDAQ up about almost 2% itself. And I mean, quite frankly, for me, it really just gets to this idea also of valuation and some of these multiples. I understand the enthusiasm, but at some point it's got to be backed up by fundamentals.
And Palantir is going to be a great test case when it comes out with the reports later on after the closing bell, given how much it's surged, 1,300% in the past 3 years.
Yeah, it's phenomenal. It's actually outperformed NVIDIA, believe it or not, over the last few years. And it gets to this idea, though, is that justified, right? You want to pay 250, 260 times earnings? Well, maybe if their addressable market and their moat around them is that sizable, sure. But if not, then what are you buying? Yeah, well, the revenue growth is going to pick up to 39% for the most recent quarter, but it's really going to peak right around there and stay at that level before tapering off in the next year. All right, one of the stocks to watch after the bell tonight. We're also going to get some earnings out of a couple other names, too. We're going to have a full breakdown of everything that happened today. All of that starts with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Scarlet Food, taking you through to that closing bell. with a global simulcast. It starts now. Carol Masser in the radio booth. Matt Miller in today for Tim Stenovic as we welcome our audiences across all of our platforms, television, radio, and our partnership with YouTube. A phenomenal day, Carol Masser, as we recoup some of the phenomenal losses from last Friday.
It's kind of amazing because Friday, I mean, it just felt like the headlines never stopped. We did see selling and then, like it never happened. We're seeing some buying into the close, and it is fairly broad-based buying today, Matt.
Yeah, I mean, we're up, 1.5%. We lost about 1.6% on Friday. So almost everything that we lost due to that horrible jobs report has been made back. Maybe the market is with Donald Trump and believes that that was just political.
You look at the two-year yield and how it's little changed after at one point dropping as much as 29 basis points on Friday. There's a lot of things that could move that, though, in the coming days. You've got some massive auctions. You've got the 10-year and the 30-year debt being sold this week.
Yeah, and don't forget, I mean, at least in terms of equities here, we also have a pretty large slate of earnings once again. I know we got the big Mag 7s out of the way other than NVIDIA, but you're going to get a lot of names that are much more consumer-facing, the Airbnbs of the world, Ubers of the world. After the bell tonight, we get Palantir, so a read on AI. So a lot that could also shape the direction of this market.
And let's not forget that we still could get news on the trade front and the tariff front, certainly from the White House. So still lots to come this week.
Absolutely. On a day where a lot of us woke up and we're kind of wondering whether Friday's sell-off would carry over into today, we got a big response by the dippers saying, Anytime we've seen these drops in the past, we've seen those people come in pretty quickly here to buy that dip, and they did it in a big way, a way that pushed the Dow Jones Industrial Average up by almost 600 points, or about 1.4% on the day. The S&P 500 pushed up by more than 90 points, or 1.5% on the day. The NASDAQ Composite pushed up 400 points, or 1.9% on the day. And the Russell 2000, that's your outperformer, 46 points higher than where it was on Friday, closing out up 2.1%.
All right, guys, as we said, pretty much broad-based buying in today's session. Scarlett, we've got 430 names gaining ground on this Monday, 71 to the downside, 2 unchanged.
Yeah, pretty lopsided there, and that's what you'll see in the IMAP as well. There is one sector that did finish in the red, and that is energy, down about 0.4% as crude oil declines about 1.5%. Certainly Brent did, at least. In terms of the gainers, communication services and tech each gaining more than 2%. Utilities also finishing up by 1.75%.
All right, guys, let's get to some of the individual gainers. This one, in fact, the number one gainer in both the S&P 500 and the NASDAQ 100, ticker is IDXX. We're talking about IDEX Labs, soaring the most intraday ever after posting a beat and raising the quarter outlook, fueled by demand at the company's companion animal division. So basically, it's got these instruments. They do cellular analysis at vet clinics, checks blood, checks some other things. But anyway, that seemed to be some outperformance. This
companion animal division. We call them pets.
Sorry. This is what happens when you read the press release. Stock's up about 64% year to date, but again, up 27%, Matt, in today's session. Wayfair, we just talked with the chief financial officer, stock up 13%. Online retailer reported second quarter results that were much stronger than expected. BI out saying that Wayfair is better than expected. Results suggest the worst is behind, and the home furnishing retailer may be on an upward trajectory. And then got to mention Joby Aviation, up about 19%, planning to buy the helicopter rideshare business of Blade Air Mobility for as much as $125 million in stock and cash. So some real big outperformers here, Matt.
All right, there are still some losers in today's market, not huge ones, but Berkshire Hathaway is a giant company and a very widely held stock. The Class B shares down right now, you can see only 3%. But it was at one point the biggest intraday drop since May 5th. So Warren Buffett's company took a $3.8 billion impairment on its Kraft Heinz stake, and that was the big concern there. By the way, Kraft Heinz is also a separately traded company. Berkshire owns, I think, 27%, but the shares in Kraft Heinz themselves also fell. On Semiconductor was a big loser today, at one point much bigger than the losses we see now. Right now, well, 15-16% is pretty serious. Those shares down after the company reported second quarter results. Revenue was slightly better than expected, but operating margin was under the consensus. Earnings and revenue guided slightly above consensus. This, according to a Truist analyst who has a $43 price target on the shares, but they are not looking good today. And then LyondellBasell, which makes plastics essentially, for a ton of consumer and automotive products. Those shares down after another drop on Friday. They had at least 12 analysts cut their price target for Lyondell Basel, including Morgan Stanley, who said the stock, JP Morgan, who said that the stock is going to trade sideways from here on out. It's a 6th day of declines.
All right, let's check in on the yield space here because we talk about the phenomenal moves that we saw in the equity market on Friday. We saw phenomenal moves in the Treasury space as well on a price basis, the strongest day for Treasuries all year long, and that continued a little bit into today, particularly on the longer end of the yield curve. Prices moving higher, yields moving lower, 3 basis points on the long end of the curve. The 2-year yield, the short end of the curve, sitting things out here, ticking higher, but only by less than 1 basis point.
You look at the bond market today, it's like Friday never happened. I mean, it's pretty remarkable how muted the action is today. And we had a day on Friday where bad economic news was interpreted as bad news for the market. Today, that bad news is being interpreted as not necessarily bad news.
Yeah, I mean, this is kind of, where we go, right? It goes back and forth. And then there was a story, right, on the Bloomberg that talked about all these Wall Street pros warning investors to get ready for some kind of drop.
Yes, I saw that.
So...
Dude, that was, what a day to click send on that story. The big take yesterday was like, yields are going up, 450 is the new normal. And meanwhile, we're at 420. I mean, yields are the most fascinating part of this market because of the fact that you had a huge rebound in stocks and we're still so far down on the levels when it comes to bond yields.
And it gets to this idea sort of where we see the next activity here. We should point out we are awaiting several earnings after the bells tonight, including from Hims and Hers and from Palantir. Palantir just crossing the wire right now. I'm going to start with the forecast. The company saying that for the full year, it sees revenue in a range of $4.14 to $4.15 billion. That's an increase over the previous guidance that it had given of about $3.9 billion on average. On adjusted operating profit, $1.91 billion to $1.92 billion. Again, raising the profit forecast up from about $1.72 billion. I'm going to go back to the quarter that just passed. That was the second quarter. The company did beat on both the top and the bottom line in that realm as well. $1 billion in revenue. Street was looking for $939 million. And on the EPS side, the company, Scarlett, posting 16 cents a share adjusted EPS. The Street, on average, was looking for 14.
All right, let's take a look at the earnings release. The company talking about how this was a phenomenal quarter. They're seeing the astonishing impact of AI leverage. And in terms of the commercial business, revenue growth of 93% year over year, revenue growth of 48% year over year as well. And they're looking at third quarter revenue. They're guiding it to 50% growth year over year as well. I mean, these are massive numbers when you look at it. Is it massive enough to justify the gains that we've seen so far? And the initial answer, at least, seems to be yes, given that the stock is up about 1.5% after hours trade.
It's interesting. We talked with our Mandeep Singh, Matt and I did earlier, and said he was focusing on that commercial segment. And he said anything below 70% would be a miss. So they easily beat and when it comes to that. But he also just talked about, this one in terms of price to sales and what we are seeing in terms of the ratio. Some real overvaluation, but at least initially it seems like investors are okay with it. And the stock is up about 2.8% here in the aftermarket.
Yeah, for the first time, U.S. commercial revenue grew faster than government revenue at 93% year over year compared to 53%. So massive
big number.
Massive release there from Palantir. We're also getting, as Romaine said, Hims and Hers earning right now. Revenue in the second quarter was $545 million. The estimate was for $552 million. So missing on the revenue line. EPS in the second quarter was 17 cents versus 6 cents the same time a year ago. And then in terms of the outlook, third quarter adjusted EBITDA, $60 million to 70. The estimate was for 76.7 million. So missing there as well. It's looking like it's going to be a down arrow story if the outlook doesn't match what the Street had, and indeed the stock is getting decimated in the after hours.
Yeah, you see Hims down about 10% here. One of the biggest decliners in the after hours trade. To the upside, though, Palantir and BioMarin, which just reported earnings. Those are your two biggest gainers. The third biggest gainer, that actually belongs to Axon. This, of course, is the maker of tasers and other defense products for the police systems here. The company did report report that net sales did come in ahead of estimates. It does look like the EPS came in a little bit light, but the company guiding higher for its full year revenue forecast and its full year EBITDA forecast. And that might be a big part of the reason you're seeing a 4% jump in the stock in the after hours trade.
And just a quick mention here of Tanger as well, the mall operator reporting, total revenue of $140.7 million. Analysts were looking for revenue of $132.9 million. So that is a beat on that front. It has also raised its full year 2025 guidance as well. As for the FFO per share, the reported number was 58 cents. That beats the average analyst estimate by about 2 pennies.
All right, in Tanger, we're seeing shares up about 0.6% here in the aftermarket. All right, folks, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Scarlett and Romaine, of course, continuing there on the TV side. Matt and I continuing here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
Stick with us here on Bloomberg Television, a fuller breakdown of some of those earnings that we just got, particularly with Palantir. That's coming up next here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romaine Bostick here with a look at a market trying to claw its way back after those phenomenal losses on Friday, posting up with some relatively phenomenal gains here on this Monday afternoon. The S&P 500 up about 1.5% on the day, and the Philly Semiconductor Index participating in the rally as well. But we saw outsized performance in the Russell 2000 today, a 2% gain there as the VIX volatility got tamped down and a bit of risk appetite crept back into this market. Crypto assets, including Bitcoin, making modest moves higher on the day. As far as the individual stocks, everybody is talking, of course, about American Eagle, a 24% jump in that stock, all based on the latest culture war volley by the president of the United States here. Investors flocking there after the president says he likes Sydney Sweeney, he likes American Eagle, and maybe you should go out and buy the stock. Meanwhile, a lot was going on in the tech space. I want to draw your attention to Figma. Those shares dropping about 27% after a phenomenal debut for that company last week. So probably just a tinge of profit taking there. And on semi down, another fan favorite here in the AI and in the semiconductor space, losing about 16%. And both of these also seem to be based on the idea of valuation. And that brings us to our top story of the day, and it is the AI trade and market valuations. While much focus has been on NVIDIA and Microsoft, the real winner of the AI trade, at least based on price appreciation, it's got to be Palantir. The data aggregator has seen its stock rise more than 2,000% since the public release of ChatGPT back in late 2022. That's more than double the price return on NVIDIA. You heard me right. And it's more than 20 times the return of the NASDAQ 100. But while the stock has surged, so too has its earnings multiple. A price now more than 250 times Palantir's projected 12-month earnings. That's the highest ratio among S&P companies. Price to sales, price to book, every fundamental ratio out there just as extreme. But consider this. Palantir's average trailing revenue growth, it's among the 10 best in the S&P 500. And its profit growth equally as impressive. We knew that prior to today. And now with the earnings that just got dropped just a few moments ago, we know that that growth story is still firmly intact, beating revenue expectations for a 20th straight quarter and showing that there is actually more life to this stock and more importantly to this company than just its government contracts. 90% growth on the commercial side of this business, maybe providing some justification for the high valuation. Those shares moving higher in the after-hours trade, one of the biggest gainers in the after-hours trade, up 3%. Before we talk a little bit more about that, I do want to take a look at one of the biggest decliners in the after-hours trade, and that's Hims & Hers. This was a darling stock for quite some time. The share is down about 10% as the telehealth company reported earnings, and there are some concerns out there about what the growth story is there. Our next guest says that we are still early in the shift to online healthcare and that Hims will still be a leader in the space. Aaron Kessler joins us right now, internet analyst over at Seaport Research Partners. And I do want to start there with the long-term story here. I mean, we can parse these numbers, and I know on the top there are some concerns here, but we're still talking a company growing subscribers by 31% in the quarter. Gross margins in the 76% range, which I think even every services company would be envious of. How sustainable is that, Aaron? And more importantly, can they accelerate that growth?
Yeah, no, we think 20% plus growth is very sustainable. Obviously, near term, they've had some nice benefits in the weight loss category. We think weight loss is just one part of the story, though, in terms of the long-term growth. Obviously, they're in a number of key verticals, such as dermatology, mental health, sexual health, a number of others, entering new categories as well. So we think 20% plus growth is sustainable. Mostly it's U.S. growth at this point. We think they're going to get more aggressive on the international side as well. But as you said, we think it's still early in the kind of online healthcare penetration, and Hims is one of the leaders in that space today.
I am curious. I mean, you have on a day like today where you have a revenue miss for the quarter, and that's probably why you're seeing the stock down 10%. I guess my question to you is, why do you think they missed? And more importantly, does it matter?
Yeah, no, I think we'll hear on the call. I mean, I think the key will be one on the weight loss side. They're projecting about $725 million plus of revenues in the weight loss category for the year. We'll look for an update that on the conference call. If you look at the non-weight loss category, kind of their core growth, that's been growing about 30%. So we'll want to see what that growth was in the quarter as well, outside of the weight loss. But yeah, we do think it probably slowed down a little bit in terms of the weight loss growth towards the end of the quarter. So that'll be a key focus for us as we hear the conference call.
Where do we stand right now? Because there's been a lot of discussion with regards to the weight loss strategy here. I mean, obviously, they kind of came into this space focusing on the generics, on the compounded versions. They finally reached agreements to be able to sell the branded versions. But we know there have been some strains in that relationship. And I am curious as to where you think that that relationship with the big drug manufacturers goes after this.
Yeah, so I think you said originally signed with Novo Nordisk, and then that kind of agreement got terminated. So a little bit of strained relationships right now. We still think it's a long-term category that they want to be in. Obviously, very important for consumers. Some of these drugs do come off of patent in a few years as well. They'll be able to sell them more easily in a generic format. So I think that's going to be a focus for them to stay in the category, as they'll be able to sell them within a few years and more of a generic format. And they have other solutions as well, as they have an oral weight loss solution. So it's not all just about GLP-1s today for them.
Do you see this company evolving to be something that I guess is just beyond just a one-trick pony, if you will? And I don't mean that it's a disparagement, but beyond just going there for weight loss drugs or ED drugs or whatever, they sort of had put their stake in the ground on. Can this become, I guess, a broader and more holistic telehealth company?
Yeah, I think that is their plans. I don't know if they're going to get to the point where they start taking insurance. Historically, it's been more of a cash pay type of site offering generics, but they are in a number of categories, as we mentioned already, looking to enter additional categories. They've talked about hormonal recently, such as menopausal support, testosterone support. So those are some of the new categories they're looking to enter in as well. But we don't think it's a one-trick pony. They're very diverse in terms of categories. We think they'll go international. And weight loss was actually a relatively new category that they entered over the last couple of years. So they've been in some existing categories for quite some time already.
A question on this, on Hims, and this is maybe a broader question, not only on Hims, but some of its competitors in the telehealth space. I mean, what sort of protects them? I mean, these are still relatively small companies, and they're playing in a space where, at least in the past, we know that big players, whether it's Amazon or whoever, can kind of step in and, in theory, replicate what they do.
Yeah.
Is that not a threat?
I mean, it's always a competitive threat, but I would say Hims does have one of the stronger brands in the space. I think some of the data we've seen is they're taking 50% of incremental dollars into some of these categories that Hims is taking. So you've seen some of the smaller competitors maybe go by the wayside, but Hims has emerged as one of the remaining, let's say, strong brands in the space, and that is pretty important going forward. Amazon has kind of replicated some of the stuff they're doing, but we don't think they've gained too much traction in some of the categories Hims is in at this point. And Hims does have a strong brand, so I don't think investors should discount that.
All right, Aaron, really appreciate you taking time for us. We'll let you get back to it. Aaron Kessler, Internet Analyst at Seaport Research Partners, as we await that conference call out of Hims, just reporting results here. The key metric here that seems to be everyone's focusing on is that miss in revenue in the most recent quarter, and the share is down about 9% here in the after-hours trade. Meanwhile, the flip side of that is Palantir. Those shares had been on a tear heading into today's report, and it looks like they are going to extend those gains, up 4% in the after-hours trade. A conversation with Brent Thill over at Jefferies when we come back to break down what we learned. This is The Close on Bloomberg. Let's get back to Palantir. The share is up about 4%. The company beating on both the top and the bottom line, but two key metrics really jumped out. A 48% growth rate overall in revenue, coming in well above what the street was looking for, and an acceleration on the commercial side of a business that has been heavily wedded to U.S. defense contracts. Brent Thill joins us right now, tech sector leader of software and internet research over at Jefferies. Brent, what jumped out at you out of this earnings report tonight?
I mean, you have a company at a rule of 90, 45% top line growth, 45% margin. That's the best you can see in software. You continue to see an acceleration in commercial, up 93%. Last quarter, they were at 71, quarter before that, 64, a quarter before that, lower. So accelerating growth in their commercial business. And, again, the numbers are fantastic. I think the biggest concern really is no one's ever seen the stock trade at 70 to 80 times revenue sustainably. We just haven't seen this. If you take the Figma IPO, that's trading at 35, 40 times. And you saw what happened, once that got past a peak multiple. So the minute that the numbers stop going higher, it's not going to be good. It's done for the stock. Fundamentals, you got to separate the two, right? The fundamentals are fantastic.
Yeah, well, this gets to the idea of kind of what the growth story is, Brent, because I was going through the multiples in preparation for the earnings. And I mean, you mentioned whatever it is, 70 to 80 times revenue. I was like almost 300 times on a earnings basis here. And I was just trying to go back and find examples of major companies that traded at multiples like that for any sort of significant stretch of time. And it was hard to find. And I do wonder.
Look at Siebel.
Okay.
Siebel Systems was going to walk on water, and they sold the company to Oracle for nothing. Same thing happened to Snowflake. Went to 50 times revenue and then traded to 6 or 7 times revenue. Datadog, same thing. There are examples all over the board. And what Palantir CEO is trying to make a point of is that they're different, that this is anything we've ever seen before in tech. They don't have the typical go-to-market team. They don't have all these costs. Their AI is so much better than anyone else. And I think, look, there's an element of that it's true.
Yeah.
It's a question of the sustainability.
Well, yeah, and I will say, too, I feel like that argument made a lot more sense, a couple years ago. There are a lot more players in this market, viable players in this market that I think Palantir might have had to itself back, in 2020 when it first became public. Is there a sense here that they should at least be worried about potential competition, not just from upstarts, but maybe even from the big traditional software companies out there?
Yeah, Palantir has done a great job of blending an application with infrastructure together. So a lot of companies can look at Databricks or Snowflake and then put together their own user interface. There's other ways that you can get to Palantir. What Palantir has done really well is they've blended both the app and infrastructure world together. The users have an ROI. They like it. They stick with it. The data's there, and they hang in it. So, again, I am a huge fundamental fan of what they're doing. What our job is to do is just break apart the multiple, and we've never, ever seen anything like this. There's not even a multiple. Like the nearest multiple is like half of that of Palantir, and the question is that sustainable? So we've, again, lived through these worlds for 30 years. We've seen this before.
Yeah.
And I think the movie ends kind of the same way, which is the minute that the growth rate starts to stall, the multiple. And right now we're not seeing a stall. We're seeing acceleration. So the question is, can they keep accelerating growth? At some point, they run into harder comps.
Yeah.
And it becomes harder to do that. So, again, nothing to take away fundamental. We've said this repeatedly. It's just valuation is what it is.
Just real quickly, Brent, on the conference call, what do you want to hear Alex Karp, out of Dave Glazer? What can they tell you that might actually make you feel a little bit more comfortable about the state we're in?
Well, I think the numbers speak for themselves. So I think the question is the sustainability of the numbers, right? So it's one thing to put up a 93% commercial number, but can you keep doing these numbers? Can you keep accelerating growth? That's the real question. And so I think that's the big one for me.
All right, Brent, we'll let you get back to it. Really appreciate you jumping on. Brent Thill, tech sector leader of software and internet research at Jefferies, on the heels of those earnings out of Palantir. Those shares now at after-market session highs, up about 5%. Of course, Palantir, a big disruptor in the data aggregating space. When we come back, we're going to talk to someone else who knows a lot about disruption in the tech space. Levine is the co-founder of Waze. He's got a new venture involving fintech Pantera. We're going to talk to him after the break, right here on The Close on Bloomberg. Welcome back. We turn our attention back to Palantir, really in a broader discussion here about disruption in the tech space. Those shares now are right around their post-market session highs after beating on the top and bottom line, guiding higher on both the top and bottom line, but still some big concerns about the valuation underpinning some of those fundamentals. Mandeep Singh joins us right now, Global Head of Technology Research at Bloomberg Intelligence. And when I look at this company, and I look at the stock, I should say, it's been on fire. A lot of people forget this stock is outperforming NVIDIA. It's outperforming pretty much everything out there, including the broader market itself. But of course, have we gotten a little bit too far ahead of where the fundamentals are when you start to talk about paying 80 times revenue, almost 300 times EPS, simply to be in this stock?
Yeah, and look, they are skewed towards U.S. government revenue. So in this case, in the quarter, we saw the U.S. government revenue really is what drove the outperformance. Yes, the commercial side did well, but the international commercial segment actually declined. So to my mind, you know, the large contracts, the U.S. Army contract and some of the other large contracts that Palantir has exposure to, a lot of that is getting recognized as revenue. Okay. Now, we know those are lumpy in nature, and they are not as recurring as a Microsoft revenue is, where it'll keep growing 35, 40%. That's where they're going to run into issues. There were a lot of large
But that was
deals.
the point of building out the commercial side of the business, right?
Yes, but commercial side, again, it's a lot of it is pipeline driven. So this quarter, they closed almost 42 deals with $10 million contracts. You're not going to get that every quarter. That is where Oracle used to outperform in the past because they had all those, you know, licensing deals, and companies pivoted to cloud so that they could have more predictable revenue. My biggest concern with Palantir is, does it have predictable revenue? Can it keep growing 40% for the next 30, 40 quarters? Then you can justify the valuation easily. But it's not the type of business model they have. I mean, they are migrating to cloud, and still early days in terms of their cloud exposure. So there's a lot of lumpiness in their contracts and how they run their business, and that is where there will be a quarter where they will not have 40 deals over 10 million. Yeah. And that's where you will see a deceleration, and I expect that to happen at some point.
All right, well, a healthy dose of skepticism going around here for what is still the best performing stock out there on the year. Mandeep Singh over at Bloomberg Intelligence, and we focus on Palantir because it quite frankly was a phenomenal story, one about disruption in this space, and I always love to talk about that, and we have really the perfect guest now joining us here in Studio 2. We go from Palantir to Pantera, a fintech company focused on helping retirees make the most of their 401k savings. And the man behind that is sitting right next to me, Uri Levine. You probably know him better as the co-founder of Waze. We all use it to, you know, avoid getting traffic tickets and to get where we need on time, and now at Pantera. Great to see you, Uri.
Thank you. Happy to be here.
I do want to talk about just the nature of your own sort of career evolution. I mean, we mentioned Waze and obviously Pantera, and there's been a lot of other things that you've been involved in. And I'm curious, when you talk about looking into, I guess, industries that maybe are ripe for change, how do you sort of approach that? I mean, how did you think about, okay, there's a better way to get from point A to point B, Waze. There's a better way to manage your finances and to get rid of, avoid, I don't know, bank fees, Pantera. How do you come up with those ideas?
So this is about value creation, right? At the end of the day, I run into a problem and I ask myself, is that how it should be? And maybe I can do something about it. And the reality is that if you look at the US market, one of the biggest challenges is that people are not going to have enough for retirement. The retirement saving is a big problem in the US. And when we look at it and decided that, wait a minute, we can change that, the main idea was that can we help Americans to retire richer? And this is why we started Pantera. This is why we built it, in order to actually help people to retire richer. Now, the challenge with retirement saving is most of us are not doing the right thing. Yeah. And so occasionally we start too late. Occasionally we kept with the default, whatever was the default of your 401k plan, and you are not getting a professional advice. And the right thing to do is actually have someone to overlook and to oversee the performance and help you out.
But give me a sense of how Pantera is different from just going out and getting a traditional advisor, you know, like some of us do.
The biggest problem, and for a second, let's imagine that you have, I don't know, $200,000 in brokerage account. right? And in addition, you have 200,000 in your 401k plan, right? Your financial advisors can easily look and manage this, but they don't have access to this. So Pontera is actually a platform, a technology platform that allows financial advisors to securely manage your own 401k plan. And the results are actually pretty significant.
How do you make sure, though, that the cost associated with that doesn't eat into potential gains long term?
It's the same way that you have chose a financial advisors to manage your brokerage account, right? So once you decide that there is a value in the financial advisors to know a bit more, to help you with the decision, to keep you disciplined, right? With your brokerage account, it's the same with this one.
Yeah. How do you do that in this environment, though? I mean, I think about my career. I mean, the first thing I did when I got a job out of college was, you set up, it was mutual funds back then, but you get yourself a mutual fund. Now, I guess today it's ETFs or whatever. But at the end of the day, I had relative low volatility in terms of what was going on in markets. We've seen over the past couple of years an increase in volatility and a lot of questions. People look at their 401k and they see the drop in stock prices and they wonder, what should I do now? How do you sort of guard against this idea of people thinking more short term rather than, say, thinking 20, 30 years out?
So look, in your retirement saving, you need to think long term, right? So there is no doubt that if you're thinking short term on your retirement, it's not going to pay off. And in many cases, we need someone to help us with those hard decisions, right? Because this is about my future, and I want to make sure that I'm doing the right thing. And the challenge here is about knowing what is the right thing to do, being able to make the hard choices, the hard decisions, and being disciplined, right? For that, many people actually prefer to have financial advisors to help them out.
When you look at some of the change, at least here in the United States, with regards to opening up 401k plans to private assets, and really just overall giving the people more control over their 401k assets, do you see that progress that we're doing here in the U.S. with regards to the government allowing these things to happen as being additive, as being net positive for those portfolios?
So in general, I think that more options create better return at the end of the day. Right? And so, but we need to make sure that they are properly managed, right? At the same time, I would say if you look at the 401k history, right? So it started with the baseline of financial institutions offering a plan, and then we have another layer which are employers, right? Because each and every plan is an employer plan, right? There are millions of plans, right? And on top of that, we have the savers, right? The people that are actually going to eventually save their money in retirement saving and eventually retire, and they need to have enough. And this middle layer creates lack of transparency between the lower level and the upper level. And this is why we are trying to look at the user or the retirement saver and put that person in the center and create the value for them.
You have obviously been a prolific founder, and I am curious just about your general view of technology, and how it's transformed traditional industries, whether it's something like access points, whether it's something like financial advising here. And how much more can it change it, particularly when you look at AI and some of these new technology tools? Do you see that as a true acceleration of this, and an acceleration in a good way?
I definitely do. I think that at the end of the day, we were harnessing technology to create better productivity, to create better life. And so I think it will continue.
All right, Uri, this is great to have you here in studio. Great to meet you. Uri Levine there is the co-founder of Waze and now co-founder of Pontera. All right, let's get a quick check of where we stand here. In the aftermarket trades, we should point out, though, with some of the after-hours moves that we had in individual stocks, you are seeing a modest increase in S&P futures, but only about a fraction. You see the big gainer there, of course, is Palantir, but to the downside, you got Hims and Hers. We also got some earnings, or we expect to get earnings out of IAC as well as Equity Residential. Unchanged on Equity Residential and IAC, down about 3%. Again, post-market moves there. And just real quickly, you see there at the bottom of your screen, we are keeping our eyes on local government issues in the state of Texas. Apparently, the Texas governor now ordering the arrest of Democrats that have abandoned the legislative session there in protest of some of the redistricting changes taking place in that state. This is The Close on Bloomberg. Welcome back to The Close. We're talking AI today, and well, right now we're talking about President Trump's AI plan, an action plan that's posing a challenge for some companies. It's a plan calling for AI systems to be free of ideological bias. And that has left some companies scrambling to test their systems for anything that can be interpreted as bias, at least interpreted as bias by the White House. Alondra Nelson is the Harold F. Linder Professor at the Institute for Advanced Study and a member of the UN advisory body on AI, and she actually helped to draft a set of AI guardrails while the Biden administration was in power. Great to see you, Alondra.
Thanks, Romain. Good to be here.
We remember the report that the Biden administration put out that was kind of supposed to structure the guardrails for AI. Unfortunately, that was released late in his term. That was ripped up by the new president. President Trump has put out his own set of guidelines. I am curious as to whether those guidelines are actually steering us towards a more innovative path or maybe one that's a little bit more potentially restrictive.
Well, I think, even probably companies that you talk to, company leaders say that innovation needs guardrails, right? Mm-hmm. Those are the rules of the road. That's what everyone knows, that that's the playing field that they're on. And so it's a little bit of a false dichotomy and a false choice to choose one or the other. I think what's good about this plan is that, it has a couple of pillars. One's on infrastructure. So we do need more energy. There's a lot of models that say more economic growth is going to require more energy. So the question is, how do you do that in a way that is responsible and is, has still commitments to the clean economy? This administration has not done that. It's sort of saying we want to do away with all kind of all constraint on sort of clean energy as we build out these data centers. And obviously communities are concerned about that. So there's a way in which there's a big continuity because AI is really the last remaining, perhaps, bipartisan issue across the administration.
But we've also seen a big break on the industry side of this. You have a certain cohort in the AI tech space that say, yeah, we want guardrails because it'll sort of help shape this industry. But you have other folks basically saying, look, the only way you innovate, the only way you sort of beat China or whoever we're competing against on this is just kind of let the dogs run, take the leashes off, and we'll all sort it out at some point in the future. I assume there's got to be a middle ground in there somewhere.
Well, I think there's a middle ground, and there's also I want to let the dogs run until I don't want to let the dogs run. So there's a way in which the interpretation of the president's executive order on, eliminating so-called ideological bias is like deeply regulatory, right? I mean, you are proposing to infringe upon the sort of rights of free speech of companies and their customers potentially. And so I think that it's, regulation for thee but not for me kind of thing, where it gets a little bit more complicated. That said, I think there is a spirit to the AI policy and the AI action plan that is really like, let everything go. And so to the extent that people take up that spirit and don't feel like they have to actually follow existing environmental rules, existing civil rights rules, existing protections for workers, that's, I think, as potentially dangerous.
Copyright rules,
and
too.
Copyright rules as well, right.
Somebody who works
you're right, indeed.
In a space like that. Ideological bias. I mean, this is kind of such a touchy subject, but when I see that word come out of the Trump administration, particularly when it comes to AI, it almost seems like you're saying, let's almost game the models to avoid saying this or to specifically say that. And I guess I'm a little uncomfortable with that because isn't the whole point of these models is they're supposed to, I guess, encapsulate the totality to some degree of what's out there?
They are supposed to, but they encapsulate the totality of what we've known in the past, right? So they're taking all of the things that we've gotten wrong, all of the sort of redlining data from real estate, the health disparities data from healthcare, and putting into these models, for example. The other thing is that what these models are fundamentally about the data that you put inside of them. So they all have some bias in some regard. So did you choose that data set and not that data set? So a computer scientist would say to you that all AI systems, all large language models are going to be biased. The question is, what are you trying to get the output to do? What are you trying to accomplish, in a classroom, in an office, et cetera? So there's no way to reduce ideological bias. There is, and I think what companies will face and businesses will face is the actual practical impossibility of kind of implementing something that says models that are inherently biased should not be biased at all, and then trying to figure out sort of vaguely what that means. Like, what is that, ideological bias to who? I think, it's the case that companies also have customers, right? And so why the White House might be saying one thing about ideological bias with regards to, let's be very clear, it's also only about procurement, right?
Yeah.
So this is aimed at companies doing business with the government. Yeah. Customers might have a whole other kind of frame on what they want their models to do.
You worked in the White House. You're now on a UN advisory body. But I do wonder, this does not seem like a global effort, meaning global in concert. I mean,
right.
I know every country or every region is working on their own sort of AI systems, but I don't see a lot of cooperation. And I wonder if that ends up maybe potentially coming back to bite us all.
You said break. I mean, this is one of the big breaks. So one of the big breaks we're seeing is with trade policy and tariffs, in which we are having more antagonistic relationships with allies and partners, including these economic relationships. There had been efforts, including this UN effort, to have more collaboration. You know, part of what the Trump administration is trying to accomplish with the AI action plan is to lead the world in global standards, right? So once the United States, the AI stack of the United States, all of the companies, all of the products, and all of the standards to be led by the United States. If you're doing that at the same time that you are creating uncertainty with your relationships with allies and partners, then that makes that a lot more complicated. And as recently as last week, you know, China said that they want to sort of pass some resolutions and sort of really move forward with global leaderships and global collaboration around AI using the multilateral process. And so the other question with the Trump AI action plan is like, are we ceding the space by trying to sort of say, you know, we lead and you all just follow and you can't sort of participate?
But with regards to the UN effort, I mean, do you envision that there will be truly some sort of international cooperative oversight of all of this?
Oversight, absolutely not. Oversight, no.
Okay,
oversight, no. But I think agreements, norms, you know, cooperations, partnerships that people agree to do things together, but oversight, no. And of course, you know, the United States has just recently said that we're no longer going to continue to pay all of our dues to the UN. There was a news last week that Antonio Guterres, the UN Secretary General, was saying that they were slashing budgets, I think, by 70%, in part because we don't have, you know, full cooperation of the United States in that body. At the same time, you know, there's a standards body like the ITU, currently led by someone in the United States, an American actually, that the Trump administration is lobbying to keep in that role so we can control the standard space and the multilateral space. Okay. So there's a lot of contradictory kind of things happening here. Yeah, and just kind of weird too. And we're sort of calling for a little bit more of a global oversight at a time where everyone's trying to tear down the global institutions for a variety of reasons. Alondra, always great to have you. Thanks for great insights. Alondra Nelson, now at the UN advisory body on AI. When we come back, we're going to set you up for what to watch over the next 24 hours, and that includes some very consequential earnings out of the semiconductor space. This is Bloomberg. Welcome back. We're awaiting earnings tomorrow out of AMD, the big chip maker set to report, providing investors with an update on AI demand and the impact on tariffs. Ian King joins us right now, who covers chips for us here at Bloomberg. And of course, when we talk about chips, Ian, all the talk, of course, for the last couple of years has been about NVIDIA. Where does AMD fit into the AI space?
Yeah, that's a very good question. If NVIDIA had a rival, which, let's face it, had over 90% market share in the crucial market it really doesn't have right now, it would be AMD. AMD is kind of the closest thing in terms of the accelerator market to a presence that even rivals NVIDIA, and has promised new products which will do a better job of doing that.
Do you think that we're going to hear that articulated tomorrow in the press release and on the conference call about those new products and when we can actually expect to see them, and I guess how viable of a competitor they're going to be?
Yeah, I mean, that's a very good point. A couple of years ago, AMD was very bullish, gave some multi-billion-dollar forecasts for this market, and you know, even bigger than that for the overall market, which got people excited. More recently, it's been a little bit more conservative, but you could argue that that has been because of the tariffs and the unclear situation that we've had with regards to geopolitics.
When you look at some of the earnings that we've gotten in, of course, out of Taiwan Semi and a couple of the other chip makers earlier this season, and then even on Semi this morning here, what is that telling you overall about demand in the chip space?
Yeah, I mean, we did a newsletter about this, which is kind of demand is okay, right? None of these markets are really shrinking. And perhaps, though, they're not growing as quickly as some would like. And what Lisa Su, the CEO of AMD, is going to have to deal with tomorrow is, unless you have a blowout investors won't like it, and we've seen multiple companies really suffer in trading after they've reported what are on the surface quite good earnings reports.
And it gets to this idea too, and I'm glad you brought up Lisa Su, because I mean everyone talks about, of course, Jensen Huang being the rock star, but we kind of forget the investment community has really just sort of lavished all types of praise on Su for what she did and how she sort of built that company. But of course, the stock isn't necessarily getting the same multiples and the same love that Nvidia is.
Well, in some respects, it actually is. At the moment, it's more expensive on a PE basis. It's the best performer this year in terms of the Philadelphia stock market semiconductor index. So this year it kind of has got some love, but obviously it's nowhere near in the same scale as Nvidia is in terms of market share and in terms of what it's achieved in terms of earnings. But compared to Intel, the company that used to beat it up all the time, doing pretty well now.
All right, well, yeah, you're right. Taking a look at the stock's done well this year, and it did well earlier in the session. Ian King over at Bloomberg as we await those earnings tomorrow after the bell. 27% revenue growth is what the street is expecting, to $7.43 billion, and adjusted EPS of about 49 cents. That's one of the things to keep your eyes on over the next 24 hours that could move the market. Some other earnings that also could have similar impact. In the morning, Pfizer, Caterpillar, Marriott, Yum Brands, BP, and Diageo, some of the names to keep an eye on. And then aftermarket, we mentioned AMD, but we're also going to get earnings out of Amgen as well out of SMCI. So two names in the tech space to also keep an eye on. Snap also reporting, as is Rivian and Lucid. So we'll get a little bit, maybe an update on what's been going on in the EV space when it comes to demand there, and more importantly, the cost structure around the companies that make those cars. On the economic data front, we get the trade balance at 8:30 a.m. Eastern out of Washington, and 10 a.m. the ISM services number. Keep an eye on that, because the ISM manufacturing number really got overshadowed by the jobs report on Friday. We'll see whether we see similar weakness in the services side of the economy, of course, the main driver of the U.S. economy. That does it for us here on The Close. Stick around. Balance of Power is up next, right here on Bloomberg.